Hello and thanks for joining us. We'll be kicking off the webinar in about 2 minutes, so stay tuned. Hello and thanks for joining us. We've got 1 minute till we start this webinar, so please stay tuned. Good morning, good afternoon, and good evening to wherever you may be tuning in from around the world. My name is Steve Hoffman, Director of Business Development for GTN, and welcome to the Mobility Tax 201 webinar, the second of a three-part series on mobility tax. These webinars are being presented by Air Inc. and GTN. GTN serves the mobility tax compliance and consulting needs of organizations with emerging to mid-sized mobility programs, while Air Inc. provides the right data, cutting-edge technology, and thought-leading advice needed to effectively deploy talent worldwide. Our speakers today are David Levitt, Director and National Practice Leader for Business Travelers at GTN, Amy Mosier, Senior Tax Accountant at GTN, and Jeremy Piccoli, Tax Manager at Air Inc. Our agenda today will cover taxation of typical assignment types, an introduction to tax equalization and tax protection, taxation of short-term assignees and business travelers, and finally, application of tax treaties. Before I pass this over to our first presenter, I want to cover some housekeeping items. There will be one continuing education credit of CPE offered for CPAs. In order to receive this credit, please select yes when asked if you would like CPE credits in our fifth polling question towards the end of the webinar. One continuing education credit for CRP and GMS will be offered for certified relocation professionals and those with the Global Mobility Specialist designations in both the live version and the recorded version. The seminar ID will be provided at the end of this presentation. Please use the question panel to ask any questions. We will allow time at the end of the presentation to answer these questions. If we don't get to your question, we will follow up after the webinar by email. You have joined this webinar in listen-only mode, and the webinar is being recorded. If you are experiencing any technical issues, please use the raise hand feature and we will assist you. You will receive a copy of today's webinar recording and a PDF of the deck. There will be a short survey at the end of the webinar. Please take the time to complete this, as your feedback will help us improve these webinars going forward. With that being said, I'll pass this over to our first presenter, Jeremy.
Thanks, Steve. Welcome everyone to the 201 session. Hope you maybe have joined us for the 101 session, but it was not a prerequisite to joining 201, and we won't be checking any transcripts. So thanks for everyone for taking the time today to join us for today's topic. We're going to start today with a polling question. As a reminder, if you want to receive credit at the end of these, please answer the polling questions required to receive the credits.
All right. So which assignment types does your company support? A, home-based equalized. B, host or host plus. C, short-term or frequent business travelers. D, rotator or commuters. Or E, I don't know.
And you can select multiple choices here. So if your company has more than one, which may be probably getting more typical around the global mobility space, you can select multiple choices here. Like I said, it's probably getting more common for more and more companies to have multiple policies, and you may even have more than one policy for each type. So you might stratify a policy to for different types of assignees. So you could have a developmental, you could have a strategic, you could have an executive policy, all under a home-based equalized, depending on your company's need. So we'll just give everyone a few more seconds here to answer the polling question, and then we'll take a look at the results.
Okay, Jeremy, the results are in, and we have an equal split between home-based equalized and short-term frequent business traveler at 74% apiece, followed by host plus at 50% and rotator commuter at 41%, and then 11% aren't sure.
Okay, yeah, that jives with what I would expect. Certainly home-based equalized is probably the most prevalent, but I think in the last few years, short-term and frequent business travelers have definitely seen an uptick in prevalence, and that's why it's a topic here today. A lot of people want to know what's happening in that realm. So that kind of meets with my expectations. So speaking of policy types, I've got a little bit of a matrix here to kind of overview kind of what the different types of policies might be. Like I mentioned, we are going to deal, my colleagues at GTN are going to talk about short-term assignments in depth, so I won't spend too much time on that. We'll talk about that in the second half of the session today. Like I mentioned, it's a very hot topic in the global mobility space. But once you get past the short term, so that's typically viewed as more than 1 year, you can still deal with the home-based equalized, which we'll talk about in a second. And then also maybe decide once you get past the 3 to 5 years, maybe you want to move more towards a host-based assignment, especially if it's going to be an indefinite or you're unsure of how long the assignment's actually going to end. So the typical treatment, again, for short-term, it's pretty much universally agreed that you're going to equalize someone for a short-term assignment. And then certainly for maybe 1 to 5 years, you might also equalize them. And then somewhere in between there, you might decide to switch to host benefits and put the person on host terms and have that person subject to tax at host. I won't spend too much time on the data elements since this is a tax session. Just keep in mind that what you might offer is going to change depending on the length and the orientation of the assignment. But you do want to provide tax support there at the end. As tax professionals here, we know that you know, it's not always easy as just saying, well, this person will figure out their tax situation, especially where more and more of the compliance risk is falling on the company. You want to make sure that your employees are properly supported, regardless of how long they're on assignment and the assignment type. So tax equalization, kind of the stalwart of global mobility. And the reason for that is the reasons you can see here. The reason why it's so popular is it really allows companies to move employees from one location to another the easiest. Now, obviously, it's the most costly, but the reason it works so well in global mobility is for a few reasons that you can see here. One, it preserves the employees' purchasing power, so it ties them to their home, but protects them for any inflation or currency changes that might occur while they're on assignment. The second one is kind of the biggest one, right? You can use it for any home and host combination. So you don't have people picking and choosing where they're going to go on assignment based on the tax situation. So you don't have people saying, well, I don't really want to go to Norway because the tax is over 50% and I might be subject to that. But I really want to go to Dubai because I won't have to pay any tax there. So the reason it's so successful in global mobility is you can say, I have a business need, and I know my employees aren't going to be picking and choosing because they know they're going to be no better or worse off from a tax perspective as a result of accepting that assignment. And that's really why it's been so successful for moving employees, is that you really eliminate that tax from the decision-making process. And tax is kind of already daunting enough, just kind of locally. People are kind of scared of it. If you're in the US, April 15th is kind of known as a doomsday, and people are already scared of it. When you add another layer of foreign tax on top of that, that they're not familiar with, it gets even more daunting. So having that kind of that perspective eliminated really eases the mobility transition. A few more things here that you can see why tax equalization is so successful. I think the biggest one is really by tying them to home. You really, and the intention is for them to go back to their home country. It really facilitates the repatriation. So they know that since they're still receiving their home salary and they're taxed at home like they would be at home, there is an expectation that they'll return home. Whether it's 6 months, 2 years, 3 years, 5 years, whatever it might be. So that's really the reason why tax equalization is so popular, even though we've kind of seen a shift towards host-based, which we'll talk about in a second. Home-based, I don't think is going anywhere because it really provides a cornerstone for any global mobility program to be able to move your employees anywhere in the world. So when we talk about tax equalization, like I said, what you're trying to do is make it so that the employee is no better or worse off from a tax perspective as a result of going on assignment. And that's really key for the employee to know, because going to another new tax jurisdiction, having to file taxes in a new location, not being familiar with the tax system in the host location can be pretty scary. So to have that in their back pocket to say, hey, no matter what happens, no matter what kind of returns we have to file, you're only responsible for what you would have paid had you just stayed at home and stayed working in your home location, which is pretty comforting when you have to deal with all the changes that go on with a move. Having tax not be one of those decision-making markers is pretty key. So how do we do that when we say someone, hey, you're tax equalized, you're going to go from your home location to this other location, you're tax equalized? How do we actually ensure that happens? And it takes a few steps. The first is that we need to determine what that home hypothetical tax would be. So we need to calculate what would you have paid on a hypothetical basis had you just stayed and worked in your home location. In some countries, in some locations, that's pretty easy to figure out. In some, it's a little bit more difficult process. Just depends. So some people just say, hey, whatever you're having withheld right now for income tax is what you're responsible for. In other locations, it might be more appropriate to do kind of a more in-depth calculation, because I've certainly seen in some locations people kind of fiddle with their withholdings before they go on assignment if they think that that's going to help them pay less tax when they're on assignment. So just coming up with a basis to determine how to calculate that home hypothetical tax is kind of the first step. So that's what you're going to withhold from them from their salary when they're actually on assignment. So there's a shift from paying actual taxes to a government and then paying hypothetical tax, which actually is paid directly to the company. Now, that's a little bit of a weird transition or weird thing for an employee to understand sometimes. They say, well, if I don't have to pay tax to my home location anymore, why does the company get to keep it? It's kind of a reaction I've seen a couple times. And one, the company is paying all the tax at host. So this does help kind of offset some of the costs. And two, it is to ensure that they're still paying something representative of their home tax liability. The second piece there, Social Security, it's actually more typical if you can to keep paying them in actual Social Security at home. So home hypothetical Social Security is not that typical. It's more common to keep someone on actual Social Security. Then the next kind of logical question that I get is, well, why don't I just keep them on actual home withholdings? Why do I have to change them from actual to hypothetical? And the reason for that is that when they're on assignment and you're paying tax in a host location, you're actually not expecting to have any, or it should be kind of minimal home liability exposure. So what you don't want to do is, let's say I have an American go out and they normally have $30,000 of federal withholdings taken out. What I don't want to have to do is pay that throughout the year when I could have been collecting that as hypothetical, which goes to the company. Because then when I take into account the foreign tax credits that I get on the home side, I might have a liability in the US of zero. So now I have to file a return and ask the IRS for a check for $30,000. And you can imagine how quick the IRS is to cut a check for $30,000 if they don't have to. It's going to draw more eyeballs, and it's just going to be more timely, perhaps increase your audit risk to try to ask the IRS for a 5-figure refund check that wasn't due in the first place. They're going to say, why did you pay this if it wasn't due? So that's really the reason why you switch to a home hypothetical tax. So now that we've determined what those numbers should be, the home hypothetical and the actual Social Security, like I said, is typical, we're actually going to withhold that from the employee through payroll deduction. So however often someone is paid, that's what we're going to withhold from them while they're on assignment. And then during the assignment, either through a shadow payroll or through actual filings of the returns, the company will pay the host tax and Social Security if due. Social Security can sometimes be exempted depending on the country, combination either through totalization or through the employee not being subject to Social Security. So it just depends. But then again, under equalization, the company is kind of incurring anything that happens at host. And then at the end of the year, you can decide whether or not tax equalization reconciliation is required. I'm going to get into a little bit more details of when that might be in a second. But that's kind of the typical life cycle of an equalization process. And you can kind of see how quickly those costs add up on the right there. Typical equalized assignment, usually what we say as a rule of thumb is going to be between 3 and 5 times the employee's base salary, just by virtue of having to pay allowances and then the tax costs. As you may or may not have heard from the one-on-one session, when you pay tax on someone's behalf, that's actually a taxable benefit, which is known as a gross up. So the taxes kind of get exponentially more expensive as a virtue of the equalization process. One thing you may have heard, I've heard this term used, is kind of tax protection. So the one difference between tax equalization and tax protection is that whereas tax equalization is that an employee is no better or worse off from a tax perspective as a result of accepting assignment, tax protection is actually basically no worse off from a tax perspective. So if there is a benefit to the employee at host to pay less tax or no tax, the employee gets to keep that. I wouldn't say this is particularly common these days, but it is something that that is kind of a relic of older policies. The idea that, if I do have a German individual that goes to Dubai and they no longer have a German tax liability, they basically get to pay no tax. The downside for the company is obviously it's always more expensive than tax equalization because the benefit, instead of going to the company, is going to the employee. Like I said, it's not that common anymore, but some employees are able to lobby for this. If they say, hey, there's no tax or there's very low tax in this country, I want to have the benefit of that. That's what tax protection is known as. So now we're going to look at some of the tax equalization and protection provisions. On the left here, we can see kind of personal income. So equalization is pretty straightforward to enact on the salary because that's controlled by the company. But there are all these other items that you have to think about under equalization. Hopefully that's written out in your policy. So the first one you can see here is spousal earned income. This is slowly being phased out. I would say that 10 to 20 years ago, this was kind of common that spouse goes on assignment and starts teaching English on the side for a few hours a week, and we'll actually equalize that income. But as the workforce dynamic has kind of changed, a few companies have found that by equalizing spousal earned income, all of a sudden they're equalizing a spouse that may earn 6 figures in US dollars. I had a company or a client that had that situation arise where they had to rewrite their policy because they didn't realize that they were on the hook for the spouse's earned income and she was an executive. So I've definitely seen the spousal earned income slowly phased out of policies. The next one here is kind of the umbrella of personal income. So interest income, dividends, capital gains, rentals. I would say that the trend is really to start to cap this. So the company will cap up to a certain amount of tax or a certain amount of income that's incurred at host, and anything over that, it's up to the employee to cover. So I would say between like $5,000 and $10,000 is kind of the cap that I'm seeing most companies enact as they're writing new policies. What you really want to avoid are employees that take advantage of uncapped and they go into a host location that maybe has a very fruitful investment environment with low taxes, and they start buying investment properties, or you want to avoid that type of situation where the company is on the hook for investment income that really isn't outside of what you would say is normal. You expect an employee to open up a bank account at the host location and maybe earn some interest, but you don't expect an employee to go in and start buying rental properties. And then the last one here is home sale. Again, something that is probably more common about 10 or 20 years ago, is where companies would kind of get involved with the home sale. So either buy it from the employee or take some sort of risk. This really blew up on a few companies that when the housing bubble happened. So companies are really washing their hands from home sale. They'll say, hey, we'll give you some money towards closing costs if you need to sell your home, but we're not assuming any risk in terms of buying the company through a partnership or assuming any loss that happens with the sale of your home. That's really your personal decision. We're happy to help out if we can. Moving into the second tier here, equity income. This is what we in the webinar business call a teaser, because we're actually going to go in depth on equity income in 301. So we'll hope you join us. We'll give you the details. This is probably after short-term assignments. This is probably the hot button issue that I get asked the most about, is how do I track and report equity income? So I hope you join us for 301. I will just say that it's really become a hot button in the mobility space, because it's basically income that governments see as tax that is owed to them, and it's getting easier to track it, and the responsibility is falling on companies to track and report it. But we'll get more in depth in that in the 301 session next month. Last bit here, tax equalizations. Do you always prepare them? Just kind of depends on the situation. I would say US outbound, you almost always have to, because you always have that US return. In other countries, you might not have to. You might be able to get away with just saying whatever we withheld from you for hypothetical tax purposes. We will just say that's your final liability. It just kind of depends on the situation. Getting into host, so we're switching from home-based equalized to host packages. The idea being that a lot of companies are seeing this as being kind of a cheaper option away from tax equalization. It's important to note that it's not always cheaper, just because moving someone from a low wage to a high wage can actually cost more money to the company. So if you have someone from a country where the wages are pretty low and you move them to a high wage country on a host salary, that can get pretty expensive, and it gets harder to move them back. So there are definitely what's known as affinity in terms of how easy is it to move someone to a host package and when is it advisable. The idea being that the more similar the countries are in terms of wages or culture, especially tax, EU is probably the easiest one to move. As you start going interregional, it gets a little bit more difficult. And then finally, let's spend a little bit more time, a little less time on kind of non-traditional assignment types. So we've got commuters. So this is the idea that someone could be living in one country or state and then driving or flying, taking a train to another one. So being aware of these situations. All these assignment types may not fall under your traditional global mobility team, but it's a good idea to kind of take inventory, take stock as your global mobility lead to understand where there are employees working. Is there any risk that the company isn't really aware of? So, even though these employees may not be getting equalization or allowances, you should probably still be aware of where they're working, because it does kind of have international tax ramifications. Remote workers, I would say in the next 5 to 10 years, this is probably going to be the next hot button topic, just because in the digital age, it's getting easier and easier to work anywhere. So the idea being that, you can't just say, hey, this person is working here. Maybe they have a little bit of a reporting requirement. The bigger risk is really corporate tax and permanent establishment. Do we have people working in places that we don't actually have an entity or operations that can subject the corporate entity to corporate tax exposure? Gig workers or independent contractors. This is kind of topical that Uber is actually arguing whether their drivers are independent contractors or workers. Not really global mobility, but the idea being that if you are hiring people, their employment status can have a pretty big impact on tax. Rotators, this is more common in the oil and gas industry. So someone that works 28 or 30 days on and then has the same amount of days off. So how are they taxed? Typically they're equalized, but there can be additional ramifications depending on where they're rotating to and from. And then, stealth assignees. So someone who's not really part of your team, but they've kind of been undercover and enjoying the fruits of mobility, but maybe outside your purview. So getting a handle on where these people are. I had a client that had someone who was equalized for more than 10 years, and it's just like at a certain point you have to cut someone off and realize that it's time to make a decision where this person is going to be working and an employee of. So that brings us to our second polling question.
So how many global mobility policies does your company have? A, none, B, 1, C, 2, D, 3 or more, or E, I don't know.
So as you're answering that question, I'm going to be passing it over to David and Amy from GTN to talk more in depth about short-term assignments. David, in your experience, in terms of this question, are you seeing clients kind of in the process of creating new policies, especially for short-term and business travelers? Are there two different policies for those different classes of employees?
Yeah, hi Jeremy, hi everyone. Absolutely, I think it's quite an interesting trend. I'd say over the last sort of decade, really. I think moving away from that traditional one, maybe two, the sort of short-term policy, long-term policy. Now looking at a variety of policies. Remote workers, you say business travelers, very different, mobile employee populations, and I think HR teams are grappling with what this actually means to the business. It's very, very different and almost like policy overkill. So how do you maintain something which companies can still work within as a framework, risk and compliance and all those sorts of things. So yeah, definitely a trend to change the number.
Yeah, it gets a little unwieldy once you have so many different types of policies. Where does this person fall into? So Michelle, why don't we take a look at the results?
Sure, and I think it's in line with what David just said. 53% said 3 or more policies, followed by that 15% with 1, 8% at 2, 9% have none, and 16% don't know.
Sure. Yeah, I've seen certainly the issue with having less policies is that if someone sees the difference between one policy and another, everything under one umbrella starts getting comparative between the two. So it makes sense to have more than one, certainly. So David, why don't you walk us through the short-term assignees and the differences that we see here?
Great. Yeah, thank you. Thanks again. And hello, everyone. We're going to spend the next section looking at some of the issues arising with short-term assignees and business travelers. And as I just alluded to, certainly over the last 10 years, I've seen very much a move away from what I call the traditional assignments, the sort of short-term, medium-term, long-term, to, as Jeremy mentioned in the sort of last slide, that sort of 5 or 6 or more different assignment types. Mobile employees, employees are looking at various wonderful ways in which to send employees globally or even domestically within state to work, and it's creating a huge amount of complexity and challenge for many businesses as they grapple with this problem. I think primarily cost is one of the driving factors, as well as attracting and retaining and moving talent quickly into different jurisdictions. So why don't we focus a little bit on, say, STAs and business travelers and the difference between them. There's probably a subtle difference, and this is sort of definition I use. There's many definitions out there. A short-term assignee is often sent to work in a host location for a defined period, and I've put here 3 to 12 months, but I know that some companies may push that to 6 to 12, even even more months, 9 to 12 potentially. But that's the sort of typical period I would see, and that's normally for a defined period as well, lasting for a particular project, particular role. So you would almost see that individual moving to that other location, and you can compare and contrast that to a business traveller, where this is an employee that maybe the business is thinking, you only need to be there maybe 1 week a month, or so you've got that sort of cumulative nature of someone building the number of days of presence in a particular country. It may be that it's just a one-off trip, which may be 30 days. It really does depend, and you can see immediately that that definition becomes quite difficult to apply in every single circumstance. So a lot of it is dependent on the number of days an individual is traveling and the intention, I would say, at the start for the purpose of that trip. And what does this create? What else is different for the business as a result? And we've just touched on this in the polling question. We see different policy types coming up, arising, because someone may be deemed, or wants, the business wants that person to move, versus someone who sticks their hand up and says, I can work anywhere. The beach in Rio sounds quite attractive at the moment. Can I work there? So you're looking at all these different policy types around these mobile employees. Ultimately, then, who owns this? Who is owning this process internally? And again, we'll come on to that in a bit of detail. The big one for me, and selfishly, obviously working in tax, this is quite an important point for me, is to almost dispel this myth of, if I'm in a particular country, another country, a host location for 183 days or less, I'm okay. That's not a problem. The authorities won't care. They won't look to tax me. There's no immigration issues, etc., etc. Actually, the trend, certainly in the last, I'd say, decade, probably longer, is that there's a growing number of countries that are becoming very sophisticated with business traveller tracking and short-term assignee tracking, and therefore taxability, payroll requirements, social security. So we'll touch on that as well. And ultimately, then, what are your reporting requirements, both from an employee perspective, tax returns, certificates of coverage, payroll, versus the employer reporting? You may have PE issues. You may have, as in the UK, Appendix 4 requirements to report business travellers into the UK. So there's all these complexities. So moving on to the next slide. Thank you. So I've basically created eight boxes of issues here, but there probably is many more to think about. I mean, selfishly, again, the first one being tax, and I touched upon this just with the last slide. The personal aspect for the individual is, working as a business traveller or a short-term assignee in a particular country may mean it's not just their employment income which is taxed, but also any personal investment income. The domestic rules for that country apply to your employee working in that country. Therefore, as I really said before, and trying to, again, dispel that myth of that 183-day mark isn't necessarily going to apply. So, day one, you could be, or your employee could be taxable in that country. There could be a payroll requirement, as well as some other factors which we'll come on to. There's a treaty network which may protect, certainly some of that employment and personal income from taxation in that other state, and we'll come on to that. I don't want to steal Amy's thunder. Social security, as we keep referring to, it's in the next session, but just to confirm here that there is a network again of social security agreements. Again, from day one, you may be required to have a certificate in place. Certainly within Europe, some countries are requiring that. You may find that there is no agreement, and business travellers and STAs actually attract a double social security aspect. But I'll leave that for now, for the next session. What does this throw up internally for the business? Well, one of the big issues, of course, is who do you know is travelling? How do you find out who is travelling? Where are they travelling to? What are they doing? How long are they there for? And often getting hold of that data is actually, almost your first hurdle. To find out actually, where do you get this data from to show where people are traveling to, and whether it's on a weekly, monthly basis for a business traveler, or perhaps someone tripping over the sort of 183-day threshold. Typically, it's travel data. Could be expense data. There's various forms, badge swipes, all various types of data that you need to sort of get hold of and track to see where people are. And then, of course, you get into well, okay, now I've got this data, what do I do with it? And it's very much around that process piece, the records and the process. So now you're tracking the individuals. That triggers various taxable events, potentially, whether it's payroll withholding or a tax return filing. And also, it's there as a record against audit defense. And I'll come on to that in a minute as well. Certainly, I've seen both internationally and domestically within the US, increasing audits for business travelers. So again, this sort of data and process and maintenance of records is really important in this space. Just bouncing down to payroll and expenses. This is, I would say, one of the more complex areas. So you have a business traveler who spends a week a month cumulatively over a 12-month period, and they are taxable. How does your payroll operate? First of all, you've got to track that individual, work out their work days, gather the compensation, and then you need to operate a payroll in both the home and the host. Hugely, complex. How's your system geared to that? Are your teams trained for that sort of complexity? There's reporting and withholding in each of those jurisdictions, and also the delivery of per diems as well. I've often seen that a per diem rate that is, should we say, not taxable in one jurisdiction, you may have a dispensation for it, for example, may not qualify in the other jurisdiction. There may be a differential. How do you approach making sure that you're reporting the right amounts in the right place? Immigration goes without saying. I'm not an immigration expert, but some of the horror stories of senior individuals within a business being stopped at the border, even in one very extreme case, actually being imprisoned for a day or two. I was actually the third person he phoned, which I took great pride in. But the immigration is a very important part of business travel and short-term assignees, making sure you have the right visa or work permit in place. Policy types we touched on, and again, it's around do you have the right policy type in place? Certainly, that tax equalization of business travelers and STAs is something I see more frequently. Also with business travelers, where there's the tax refund in the home country is probably a small amount. It's almost the company's deciding, hey, we're not going to worry about that. That's the employee can keep that small refund because it's less than the compliance, the machine to actually recover it. So again, things to think about there from policy point of view. And the last box is just really to touch on some other areas. I could talk about this for hours, but there's some other areas here. Permanent establishment, I didn't write down, but that is another key aspect of business travelers. What are these individuals doing? Some countries are much more aggressive than others around, why you're present in that particular country. Don't forget employment law as well. What rights does that employee have in that other jurisdiction, even as a business traveler or an STA? And then you've got regulatory VAT aspects as well, and getting refunds potentially. And lastly, safety. Do you know where your people are? And if there is a natural disaster or some other event, are you prepared to do you know where they are, and how would you deal with those situations? So on to the next slide, please.
Okay, polling question number 3. Does your business manage business traveler risk globally? A, no. B, we're thinking about it but haven't done anything. C, we have started to do something. D, yes, we're on top of it. Or E, not applicable.
And David, as people are getting a chance to answer this, I think the reason that STAs and especially business travelers have been such a popular topic in global mobility is probably because technology has caught up to the workforce. So for better or for worse, everyone has a GPS in their pockets at all times. So it's just getting easier and easier for governments to check. It's not stamping a passport. It's easy enough for during an audit to determine where an employee was, their exact location, and how long they were there for. And that's why it's becoming much more prevalent. Would you say?
Yeah, absolutely. And I think the interesting thing for me is I think the tax authorities obviously started to, they were realizing they were missing the dollar, the pound, the euro, whatever currency that prevails in that particular country. And business travelers and STAs were almost flying under the radar a bit. And as you say, they've implemented, some countries have implemented, tracking programs, or should I say they require the employer to report on this basis. The rules are there, they're very clear. There's a sort of statutory requirement that to report business travelers. Then you look at, well, what's the risk profile of that for a particular company, sorry. So yeah, so it's very interesting how the trend is shifting with governments as well, becoming much more savvy.
Sure. Michelle, do we have the results?
We do. So it looks like 33% have started to do something about it, which is great, and 22% are on top of it. And then 11% said no, and then 11% are also thinking about it, but haven't done anything. And finally, it's not applicable to 23%.
Right, and I think that's pretty much consistent with what I see across the industry, the market as such. Different sectors are ahead in some ways and others. I think regulation in the financial services market has probably pushed that particular group to do something a bit, a bit sooner than others. I think other market sectors are sort of catching up. But yeah, very interesting spread. Thank you. That's very useful. Okay, so the next two slides, we're back through there. Thank you. Just to give a quick update on where we are and what I'm seeing from a US state to state. So this will apply both to companies in the US and obviously sending employees here. So as I'm sure you're all aware, the US equally has a state taxing system as well. Not every state. I think there's about 8 states that don't have what they call a general state income tax. On a sort of employment income, and they're the light blue states there. And then this is where the complexity arises, because you get some states that are actually require withholding on the first day of travel within the state, which is the dark blue, and other states that actually require withholding after reaching a specific threshold of the employment income, which is the green states. And within that, in the days and the withholding requirements, again, that can vary between states as well. So there is this lobby and an act that's been put forward now. I think it's something like 17 or 18 years it's been put to Congress. The Mobile Workforce State Income Tax Simplification Act, which is what they're trying to argue here is that it forms a standard number of days before which an individual is taxed in that state. So let's say it's 30, which is typically what they're arguing for, which is great. It hasn't succeeded, as I said, for a number of years. Some states, New York, you're taxable from day 1, withholding kicks in day 14. So, here you are, New York wouldn't particularly want that agreement to be 30. So again, just be aware that the state rules also add another layer of complexity. And just to touch as well on where I'm seeing audits, certainly the most aggressive states, California and New York, where typically the actual state inspector, who's coming to audit payroll, will ask the questions. Have you got business travelers into your operation in the particular state? How do you track them, and how are you ensuring that you're compliant? And I've seen many businesses sort of scramble around again, trying to grab that data to work out what their risk is, settling, and then implementing a process. So just to give some food for thought about the approach of some of the states. And if we move on to the next one, and again, just a brief glimpse of a global picture as well, some travel sort of hotspots for business travelers and STAs. You may all be aware the UK has a corporate reporting requirement for business travellers due at the end of this month. So this is anyone business travelling into the UK, the company needs to track and report individuals that are covered under a treaty. So again, something to think about there. Some states don't follow the treaty, California being a great example there. And equally, there are some states that don't even have treaties with each other. So Brazil, Singapore, and the US is no tax treaty. Equally, India to the US. There's various things to think about on those country combinations as well. And I also want to make one more point there, and Jeremy touched upon that. The data sharing between states, often written into tax treaties, is also increasing. They're happy to share, traveller records, etc. So this is a growing trend, and even within the country, immigration to tax is equally, certainly in some European countries, being linked together. So the days of ignorance are numbered, I would say.
Polling question number 4, who looks after your business travelers internally? A, human resources or mobility. B, immigration. C, corporate tax. D, travel or payroll. E, something else.
I'm just going to give it another few seconds before we display the results.
Thank you. Yeah, I'm really interested to see where this one falls. Because I don't know, Jeremy, if you have you any views on this? Have you? I guess it's
I think we're going to see it all over the place. I think it's just really hard to get it under one umbrella because there's just different needs. There's not necessarily an internal say, hey, this person is going on a 5-day or a 10-day, so this falls under this person's responsibility. I think it's kind of going to be all over the place, and this is really the challenge for most companies at this point is, how do I keep track of all these people? One week trip isn't that big deal, but if they're taking it every month, then all of a sudden it is a big deal. And how do I make sure that, as the global mobility lead, how do I make sure that I'm aware of these people?
Yeah, absolutely.
So it looks like the majority at 55% is under human resources or mobility, then 22% travel or payroll, 19% other, and then 2% each for immigration and corporate tax.
Excellent. Yeah, I get asked this question so much. Who owns it? It's almost, you often see someone will raise it internally as an issue, and then they don't want to own it because they know that the complexity around it is so huge that it's almost the poison chalice. So I've seen, that sort of kind of reflects what I've seen. It'd be interesting to see what the other piece breaks down as if we had more chance. But very interesting. Thank you for sharing that. And I'm on to my last slide now. So the last slide, I'll briefly touch on this because I'm conscious of time as well. We want to get onto the tax treaties piece. This is just to give some sort of reassurance. The tracking, the getting hold of data around business travellers is hugely complex. And as I've just mentioned, lots of people necessarily don't want to own the process and actually the overall task. I see sort of 4 cornerstones as sort of fundamentally underpinning the overall process. Policy being one of them. We've touched on that quite a bit. Process. So again, who owns it? Is it a steering committee that actually owns it with the various important departments as opposed to just one individual? What's your escalation point? Where do you get the data from? Those sorts of things. Technology. There's many technology offerings out there. I see them as an enabler. They're not the solution. They will give you a good ability to gather the data, process that, and look at the actual results and decide on what the next steps are. So again, very important part of the process, but not the defining aspect of it. And then the last piece, tax technical, and you just flashed there ahead. What needs to be done from a tax technical perspective, payroll, the treaties apply, and that sort of thing. And with that, I will hand over to Amy.
Thanks, David. So now we'll move into the exciting tax technical analysis of the short-term assignments and business travelers. and we'll take a look at income tax treaties and the application of such treaties. So many countries have agreements with other countries in order to mitigate double taxation, which is a circumstance where a taxpayer is subject to tax on the same income in more than one taxing jurisdiction. If an employee is liable to pay tax in one country based on criteria specific to that country and subsequently is taxable in a second country on the same income, a double tax treaty could be relied upon to avoid double taxation. So we want to get an understanding of maybe some general reasons why tax treaty agreements are in existence. So we've mentioned to reduce double taxation. And it's important to note here that we may be able to reduce double taxation, but maybe not eliminate double tax. This depends on the taxability of certain compensation items and relative tax rates in the country combinations at hand. So some residual liabilities may exist. Another reason for a tax treaty is to support cross-border trade or business. The cost, as you can imagine, could be very high to employers sending employees to work in a host country or employees considering an assignment to a host country if they were liable to pay tax on the same income in two jurisdictions. So really, consideration and analysis of a treaty, if one exists, should be given prior to offering an assignment or taking an assignment to understand the tax costs associated and any compliance requirements. And while treaties cover income tax, inheritance, value-added taxes, they do not, an income tax treaty is not covering social taxes. As it was mentioned before, separate agreements exist. These are known as totalization agreements. And session 301 will cover all of the features of the totalization agreement. So tune in for that. We can go to the next slide. All right, so David mentioned the 183-day mark as something that a lot of people know about or hear about. And while the 183-day threshold is a general guideline, it's not the only factor when we consider the application of a double tax treaty. So we'll want to look at what we call the dependent personal services article. This is often Article 15 of the income tax treaty. And the purpose is for exemption for services performed in a host location. However, the starting point is really when an employee travels to a host location, that income is taxable in the country where the employment is exercised. And then from here, we would look at paragraph 2 of the dependent personal services article, which provides exemption and indicates the employee is taxable in the home country if these following 3 conditions are met simultaneously. So the condition 1 indicates the employee is present in the other state for a period or periods not exceeding in the aggregate 183 days in the treaty period. And that can be a calendar year, a fiscal year, or a 12-month period. Condition 2 indicates the remuneration is paid on or on behalf of an employer who is not a resident of that state. And then condition 3 indicates the remuneration is not borne by a permanent establishment which the employer has in that state. So those are the 3 tests to consider when we're looking at paragraph 2. But it's important to note that these are general conditions of the dependent personal services article. However, it's not indicative of every treaty. So for instance, in the US and to Canada income tax treaty, the condition would state that the remuneration must not exceed $10,000. That's unique to that treaty. Or in the Philippines to US treaty, the condition states the period of time must not exceed 90 days. So we can't rely on those 3 to be the same for every treaty. And we'll want to really take a look at the language that's specific to the country combination we're considering. There are a few other issues and considerations to take a look at. One is the economic versus legal employer. The OECD has made some commentary regarding who we should consider the economic employer when an employee is on, maybe remains on home country payroll, but is in a host country for less than 183 days. Is the controller of the contract the only factor in determining the economic employer? And ultimately, they've commented that no, it should be some more substance over form when considering who would be the economic employer. So some things to consider are who has the authority to instruct the employee, who's bearing the risk and the responsibility of the work performed, who can hire and fire and discipline an employee. And these are only guidelines and do not indicate ultimate determination of economic versus informal employer. And some countries use the formal employer approach. However, there are many countries that do rely on economic employer determination. So you really want to take a look at that considering your specific country combination. Another consideration, and David touched a little bit on this as well, is state taxes. So some countries have a federal and state taxing jurisdiction, and those may or may not follow the same guidelines regarding treaty application. So here in the US, the state of California, for instance, does not follow federal acceptance of a treaty position, and the employer may be taxable from day one, even if they qualify for a federal treaty position. And then social taxes, as previously mentioned, are not covered under the income tax treaty and would be under the totalization agreement. Should be a factor in consideration, but again, further discussion to come on that in the next session. And we can skip to the last slide. So it's often the case in short-term assignments and business travelers that these people may not break residency in their home country just based on the amount of time they're going to be out of the home country. However, they may establish residency in a host country. So ultimately they'll have dual residency. So what happens in these instances if they're considered a resident in two countries? And this is where we'll look to Article 4 generally of the treaty, which is known as the tiebreaker, to determine which country has rights to taxation. And to do so, we'll kind of start with this first box on the left here and consider a set of facts that we'll call the vital interest facts. So this can be where their family is located, maybe where their family home is, among other factors that kind of contribute to daily life. It's not a definitive list, but if we look at all factors and it's very clear which country, qualifies as their center of vital interest, that's great. However, if it's not clear, we're going to move on to a next set of factors, which is in that second box, and try to determine where the employee may have a habitual abode. So it could be that they very clearly have a habitual abode in one country over the other. Again, it may be that they have one in both locations. At which case we'd move on to the next kind of set of criteria, which is determining are they a citizen in one of the countries where they're a resident. And if yes, then great. If not, we may move on to the final kind of prong there, which is this mutual agreement between the contracting states. This last prong is pretty uncommon and not seen very often in common practice, but just there for your knowledge. So obviously a pretty brief overview of residence, but we've kind of scratched the surface on the issues and complexity surrounding the application and analysis of tax treaties. And it's important to note that even if we're relying on a treaty position, compliance requirements may still exist in certain taxing jurisdictions, even if there's no tax liability ultimately. So it's recommended when you're examining the short-term business assignees and business traveler scenarios that you're considering considering treaty applications that speak to somebody on managing these types of populations. Back to you, Michelle, for the final polling question.
Thank you, Amy. So we're almost out of time, so I know we won't get to all questions, but real quick, there are two important things to cover. If you need a CPE credit for this course, if you could please complete the poll that I'm launching on the screen now. So that is important. And then there are a number of slides after this in this deck that talk about CRP credit information. Due to the time, I won't get into the detail on that right now, but for this live session, the ID number is 15791. Again, that's 15791, and that's for the CRP and GMS credit. And if later a person is listening to this recorded session, the recorded ID is 15792. And again, that's 15792. And then if everybody has voted, I am going to launch one final poll before we get to the actual questions. And this is with regard to if you would like a representative from GTN or ARINC to follow up with you, if you could please complete the poll that's on the screen right now. And while you're doing that, we will try to get to a couple of questions. There are quite a number, so we will, the ones we do not get to at this point, we will follow up with you within the next couple of days. So let's see, there's a question here from, let's see, there's a lot of questions, so let me start. Okay, so this one is from David. Are you finding companies are taking certain corporate thresholds for day one versus day 183 reporting, i.e. away from home rules for US nationals that are on short-term assignments to a foreign entity, or at some point you have to establish standards or else it would not be practical to have any foreign travelers?
Yeah, good question. Yeah, I think the way to approach this is to look at obviously the countries that you're going to, and seeing whether they are a day one, if there's a day one requirement there. I see very few going towards 183. I think market sort of industry practice is about 30. So yes, there's a requirement from day one, but we'll track and we'll monitor, and at day 30, that's when we'll consider taking an action, whether it's withholding and whatever. Occasionally day 60, very rarely anything more than that.
Great, thank you. And then another question from Regina. If I offer an assignee a host-based package, should I also offer tax equalization?
So I think this is kind of the idea of, I'm providing a host plus package, but maybe some additional elements, some housing or whatnot. So the idea being, do I just gross those items up, or do I need to reconcile at the end of the year? It just kind of depends on your process. They're not traditionally equalized back to their home country in this case, but it's more of if I am providing additional elements that are taxable at host, do I just gross them up at a rate that I'm comfortable with, that I don't have to do a true up? Or do I actually need to do a true up to make sure that that I've grossed up at the appropriate rate?
Great, thank you. And I think we have time for one more question. I hear that tax equalization is very expensive. Why do companies still use tax equalization?
Yeah, it's just the easiest way to move people. So the idea being that you can move any combination, move an employee from one place to the next, and know that they're going to be treated equitably. They're not kind of better or worse off from either a purchasing power or a tax perspective. It's always going to be kind of even though it is usually going to be the most expensive, it's the fairest way to treat all of your employees within your mobility program.
Okay, great. And unfortunately, we are out of time. There are a lot of other questions, and there are a few questions about the credits. All the credits are explained in the slide deck, which you will receive a copy of, as well as a link to this recording. And one final request is, if you have a moment at the end of this session, if you could please complete the survey that you're presented with, as it will help us improve our webinars going forward. And then finally, our next session, Mobility Tax 301, we'll discuss taxation of deferred compensation and pensions, Social Security and totalization, compensation structuring for global mobility. And if you have not registered for that session, you can do so on the AIRRANK website, and it's on June 11th at 2 p.m. So thank you, David, Jeremy, and Amy, and thank you everyone for joining us today.